risk is and what the profit potential is. So profit potential is those multi-tested highs here, and I would view this as a Harami. But even if it wasn't Harami, we've had resistance here tested once, twice, 3 times, 4 times, maybe even here you can say it's a resistance area. So we'll extend the resistance zone to here. So on this tall white real body, although it's a classic bullish engulfing pattern that wraps around many black real bodies, this would not be a trade that's warranted. Why? Because if you're buying here, you're buying right at resistance, and that is not a very good strategy. You know, perhaps if you wanted to, you could break on the break above the resistance area here. Think about buying it over here on this little arrow. Let me just make it a little clearer here. Over here. Because that would be a bullish breakout. And although the candlesticks are mainly reversal signals, nothing wrong with trading momentum. In other words, let the market break above a resistance area and go in from the long side. So if you did buy in a move above this resistance area, maybe when you saw this bearish engulfing pattern, it would be a time to exit. Remember, candles are really good for exiting, not only entering markets. Let's move on to the next one now. Okay, what would you do? So first of all, we have a bearish engulfing pattern here, just to bring that out. Now, we're at this juncture here. Okay, and this red arrow. Question is, 1, would you buy at the arrow? 2, where is your stop? And 3, what are some targets? Remember, with 2 and 3, we're defining our risk-reward. Our risk is a stop, the protective stop, and our potential reward is the target. So, put the player control on pause, and would you be buying on that white real body? Okay, first of all, that white real body is a bullish engulfing pattern. See how this white candle wrapped around the small black real body? It's also confirming a support level, which is a plus. So we have a bullish engulfing pattern at a support area. So now, how do we get our stop? Well, the low of the bullish engulfing pattern is our potential stop out area, right? So that's our risk. So if we're buying it here, on the close, our risk is down here. And this looks like a really good support area because not only is it the low of the bullish engulfing pattern, but it's been tested numerous times. This happens to be an intraday chart, but it's been tested numerous times since this arrow over here, so quite a few times. So based on support, this would be our risk. And over here, something like that. And next are, what are some of the targets? And again, you may have different targets, but I'll show you some of the ways that we look at targets for our institutional clients. For example, this would be our first resistance, what we call R1, because it was tested quite a few times here. Next potential target would be just the pivot high here, the recent high over here. This is not a dark cloud cover, by the way. Why? Because the black real body did not get into the white real body. Nonetheless, it was a pivot high. And the major resistance, to me, a potential longer-term target, would be the high of the bearish engulfing pattern over here to the doji here. So we would call this R1. For our first resistance, this would be R2, and this would be R3. Now, some traders will like to look at angle trend lines. So although my first resistance would be here, remember we call that R1, okay, yours might be here. As I mentioned before, I'm not really big on angle trend lines. I like horizontal support and resistance much better. But if your target was here, if your first resistance was here, and to me that wouldn't be very important, but if you find that in your markets that you find angled trend lines work well, you would not do this trade. See, if your target was here and your stop was here, in your trading style, that would be a bad risk reward. You wouldn't do it. Whereas me, who will be looking at just recent highs, this is an okay risk reward because my reward is here and my risk is down here. So we can all define our potential stop out level at the same zone because we all could be using a bullish engulfing pattern as our stop out level, but the target is purely subjective. Okay, what would you do? And okay, assume you're flat. And I give you a little hint here. Look at the prior lows. In other words, these lows here. So put it on pause and we'll give the answer. Okay, so this green arrow is the same candlestick line we were looking at before. I'll show you here. It looks like around July 20th. So this is July 20th. The answer is, what would you do? And if you remember, we gave you a hint with the prior lows. So we could see this is not obviously this is not a hammer, right? Because that upper shadow is way too long. But although it's not a candlestick signal, the inability of the bears to hold the market under the lows, under those two red horizontal lines, is one of my favorite Western tools. Remember we talked before in some of the earlier slides about the falling off the roof where the market breaks above resistance and the bulls fail to hold it. There's a flip side. This is when the market breaks under a support area via those two horizontal red lines and the bears fail to hold it. This is the famous crack and snap. And what's good about this is we get a potential target and a stop-out level. The stop-out level for the crack and snap would be the low of the move. The target would be the recent highs. And this happens to be a dark cloud cover because the black candle got deeply into the white candle. So this would have been a very attractive risk-reward. So this brings out an aspect that with a crack and snap, you really don't need a candlestick signal to confirm it. And by the way, notice this white candle here, wrapping around the black real body, bullish engulfing pattern. The low of the bullish engulfing pattern down here became support. Although the market moved under it, it didn't close under it. So the support area of the bullish engulfing pattern held, and then we had a Western charting technique, the crack and snap, giving us the buy signal. Okay, this next series of slides is really interesting, or are really interesting, so we'll go through them. Okay, so what would you do? And this is a multi-part slide. Okay, so first of all, we have a shooting star here. And what would you do? So let's put this player on pause and think about it. Okay, so here we have the shooting star. We're looking at the answer now. And in the red semicircle, obviously a bearish engulfing pattern. So we have the shooting star confirming the resistance area at the bearish engulfing pattern. So we have a grouping of signals. So do we do a trade on here? Do we think about a short sale? And let's think about the risk reward. Okay, now this market essentially has been in a trading range. See these two red horizontal lines? This is the bottom end of the range. So with the market at the top end of the range here, failing with the shooting star, we could expect a rejection of these higher levels and perhaps a return to the bottom end of the trading range. By the way, notice how the shooting star here, the upper shadow got a little above the resistance area of the bearish engulfing pattern. Doesn't matter. It has to close above it to say that the resistance was broken. So this did not break resistance.